And I looked at the initial handout, and I said to Sujit just now, he had 47 slides in 30 minutes, and you're going to have to move real fast. But he says he's already cut down the number of slides. I trust him.
Okay, thanks very much. I'd like to start by thanking John, David and Adrian for inviting me to the conference. I probably owe them a lot more actually, because I did my DPhil in Oxford and John was my supervisor. David taught me and I was funded by the ESRC. And obviously the usual disclaimer, these are my own views and not those of the Bank of England. There were a set of questions that were sent around by John in terms of the themes that these talks might cover. I'm going to focus on two in particular: the causes and dynamics of the global financial crisis and policy responses in light of that. And I'm going to try to explain how some techniques and examples from ecology and epidemiology might be relevant to thinking about those questions. And my particular area, but it's going to be quite a narrow sort of focus of application. So I'm going to focus specifically on modelling contagion in financial systems. So I'll start with some stylised facts, I will draw some broad lessons, and then through the main part of the presentation, I will explain how these techniques might be relevant, set up some example sort of models, talk about some of the policy conclusions that you can get from those models. So to start with, I thought I'd share a picture of the type of system that we want to model. This is the UK interbank network from a snapshot just before the crisis. So this is based on real data. The nodes here, the red blobs, are banks. You can probably guess which ones the ones in the middle are. The lines between them are interbank lending or borrowing relationships where there's some sort of size cut-off, but the darkness of those lines reflects the size of those relationships. So first of all, what can you see from this? I think two things I would draw out. One is it's obviously a highly complex system. There's a lot of interlinkages going on. And secondly, it's highly concentrated. So the size of the nodes here is scaled in proportion to their importance in the market. And you can see a set of core nodes here in the centre. Unfortunately, I don't have that picture over time. But what we can see, looking at UK and US data, is how such intra-financial system activity has evolved over a longer horizon into sort of the aggregate. So what the left-hand chart here shows a breakdown of UK debt since the late 1980s. And, you know, as has often been talked about, household debt grew quite a bit, so did corporate debt. But what I want to highlight here is the green here, which is financial corporate debt, which includes banks and exposures between banks. And between 2003 and 2007, the green accounted for 2/3 of the growth in the total of debt to GDP. So, although household and corporate debt played a big role, intra-financial system debt was very important in the exuberance before the crisis. You also see a similar pattern in the US. This is on a sort of a narrower definition, but this is repos and financial market. It's actually a better definition, really. But repos and CP is a proportion of retail deposits. And you see this marked increase before the crisis, and then the procyclicality, so a sort of procyclical pattern, a fall off during the crisis, the sort of so-called run on the repo. So complex, concentrated, but also quite cyclical. The third chart, this is just indicative, but the point I want to make here is that the system also became increasingly homogeneous. So this is just one example. It shows that you had similar return patterns across different business models. There's a range of different evidence that speaks to this. Probably two reasons for that. First, the models that banks use, the risk management models, sort of encouraged diversification, but the banks then often became diversified in very similar ways. The use of ratings also amplified that sort of behaviour. And then the second thing would be the thing that Paul Tucker talked about last night, sort of search for yield, a need to keep up with the Goldman Sachses of the world and get these high returns. And that sort of led to a situation where, maybe to caricature it a bit, savings cooperatives turn themselves into commercial banks turn themselves into investment banks, and investment banks turn themselves into hedge funds. So that there was this sort of spectrum of searching for yield and pursuing return, which led the system to become increasingly homogeneous. So I think those stylised facts paint a picture of a complex, concentrated, increasingly homogeneous system. Now, certainly amongst market participants, I won't speculate on economists, but the view was that this sort of behaviour was technical progress in finance, better risk management, and it was good for stability. If an ecologist had looked at those things, they would have been quite worried, because for them, complexity coupled with homogeneity is often associated, not necessarily always, but quite often, with fragility. So the sorts of examples that they might speak about would be, if you look at grasslands or savannas, they're quite simple ecosystems, which are quite robust, compared to, say, tropical rainforests, which are much more complex ecosystems and can be quite fragile. They would look at, if you do have a complex system, like a forest, that if you have modularity, fire break might be a good analogy, then it actually helps to make it more robust. So if you do have complexity, at least you want some sort of modularity. And they would also potentially discuss how diversity would be quite important. So whether that's thinking about how resilient fisheries are to sort of collapse, or how resistant crops are to disease. So diversity in the pool of crops or fisheries would help to enhance stability. That's sort of the pre-crisis evolution of what was going on in financial markets. What about the approach to regulation? To caricature it, pre-crisis financial regulation, firstly, it was static. So there was no time variation, no attempt to sort of target this increasing, or worry about this increasing search for yield in the sense of toughening up capital or liquidity requirements on banks or other financial institutions. And second, it was focused on a very much individual institution perspective. So supervisors looked at banks. If they were diversified, they were judged to be less risky. And there was no sense of the systemic consequences of bank failure. Now, because larger banks are typically more diversified, that actually meant that, if you look at, this is in capital ratio or leverage ratio space, that larger banks typically were less well capitalised than smaller ones. And that was very much from this sort of node-by-node approach to regulation. Again, what might an ecologist say? Again, there are lots of, this is just one example from ecology, there are lots of different things, but in some parts of ecology, there's an emphasis on a system-wide approach to management. So, for example, when fishing quotas were first introduced, they were set on a species-by-species basis. And in some instances, that led to sort of collapse in the ecosystems because it was taken, it was one fish group by another fish group taken on an individual basis. And what wasn't taken into account was the interactions between the different groups. And so more recently, in some cases, they've taken a more system-wide approach, which has been a better way of setting fishing quotas. That gives a sense of some of the broad high-level lessons. What I want to now do is take a specific example from epidemiology to highlight some of these points. It also gives some core intuition that underpins the economic models that I'm going to show you very shortly. And it actually relates to some of the cascade discussion that Jean-Philippe was talking about previously. So think about this. Suppose that flu is spreading around Oxford, and I'm interested in knowing when a disease is going to spread around the population. Now suppose that everyone spreads the disease to exactly 1 in 10 of their friends. Now I think it's quite obvious that if everyone has exactly 9 friends, at each successive stage the disease isn't going to spread as much, and therefore it's going to die out in the population. On the other hand, if everyone has 11 friends, it's going to go viral. Everyone in Oxford, or everyone in the UK, whatever you want to think of as your population, is going to have flu. And what that highlights is that there's a fundamental discontinuity. Tipping point is a word that's often used, or phase transition mathematically, in this very simple stylized example, at 10 friends, where the system flips from a virus that's not going to spread to one in which becomes a sort of global cascade or global virus. Now that's all for, well, you might say all my talk's far too simple, but that's certainly far too simple. In reality, some people are going to be better connected than others. And obviously, people with more friends are going to spread the disease more widely. But what's also important is that if you have more friends, you're also more likely to catch the disease in the first place, because you have more friends to catch it from. So actually, connectivity enters twice. And a person with 10 friends is actually going to be 100 times more important in spreading the disease than someone with one friend. And what that highlights is that these sort of highly connected, what I've called super spreaders, are key to the propagation of contagion. They're the ones that are very important in spreading the virus. And in epidemiology, that speaks to policy responses where you try to target those. So if you've got a fixed stock of a vaccine, it's well known that you should target the most connected first. Similarly, education programs around HIV were tried in some, with varying degrees of success in different countries, but we're trying to target the people who would be most important to the spread of HIV. Now that's all, you might say, well, that's all a bit mechanical, there's no behaviour, and that's going to be a big issue when we come on to economic models, but even in epidemiology, behaviour is important, because, humans react to disease, obviously. And two typical behavioural responses are flight or hide. Now, flight is where you kind of run away from the disease, run away from Oxford because flu is breaking out here. That's actually quite bad for contagion because it spreads the disease elsewhere. So in 1878, yellow fever was breaking out in Memphis. In that year, half the population of Memphis fled. And if you followed the pattern of disease, it went out on the railroad lines that went out of Memphis. So a flight sort of literally spreading the disease along these railway lines. A better response in an epidemiological sense is quarantine or staying at home. So in the SARS epidemic, flight was in some cases quite literally banned, right? You could not fly. And there is some evidence that that helped to contain the outbreak of SARS. Now, there were lots of other things as well, but this is just to highlight how behavioural responses can be important in epidemiological models, just as they are in economic systems. So why have I gone through that example? I hope what I've tried to show you with that, it's a very simple example, but a lot of these lessons are going to carry forward for the economic models that I'm going to go on to. But I think it highlights a few things. It highlights how you can get contagion. You can get nonlinearity. So a very small change in some parameters, like moving from 9 friends to 11 friends, can have a very big effect. Very similar shocks, depending on whether it's a very connected person or a person at the periphery of the network, can lead to very different outcomes. So, the models naturally include heterogeneity. You get these sorts of interesting dynamics and path dependence, and you can, as I've just illustrated, actually get some behavioural feedbacks and amplifiers even in an epidemiological setup. And I guess we think of all of these things as being really key dimensions of systemic risk. Now that's not to say that financial systems are the same. And they have some really important differences. So balance sheets, I'll explain, an example balance sheet in a second. The links are directed and they're weighted, so the value of lending and borrowing matters much more than whether you're actually connected, to be honest. There's the possibility of risk sharing. So in epidemiology, there are some exceptions, but it's typically the case that the more connected people are, the more likely the disease is to spread. In economics, there's a possibility that as you have more links, you could diversify your risks better across your counterparties. So there's this possibility of risk sharing. And then, perhaps more subtly, there's local dependence. So suppose that David and John have got flu, and that I meet them at coffee afterwards. That if I meet David, I've got some probability of catching flu off him, and then I meet John, and I've got some independent probability of catching flu. Now suppose that I've lent them both £100, and David defaults on the £100. I'm now more likely to get into trouble from John's subsequent default on the £100 that he owes me. So there's an independence between the two of them, which isn't there in the epidemiological systems. And behavioural responses are obviously key, but I use hide and flight. What might the analogies be? Well, you could think of hide as sort of liquidity hoarding, which I'll talk about, so keeping your liquidity at home, which is quite bad. So unlike the self-quarantine, which was good. Flight, maybe you could think of an analogy like fire sales, chucking assets, which are going to have adverse contagious feedbacks. So the models I'm going to show you have all of these features in them. That's some literature that I'm broadly speaking to. There's a nice overview paper by Andy Holden and Bob May. Okay, so what I'm going to try to do is show some common features of the model and some examples of simulation results. So the models typically have n financial intermediaries, call them banks for short. They're connected to each other by their unsecured interbank assets and liabilities in a network. Now, clearly, every borrowing relationship for one person is a lending relationship for another, so the average number of links across the network, all links start and end. We'll call this average degree. That's a measure of the connectivity of the network, so how connected the network. Now, in the theoretical setups of these models, the distribution of links is arbitrary. Obviously, when you simulate, you have to assume a particular distributional assumption, which I'll explain. What about the balance sheet? I've taken a sort of a slightly more complicated balance sheet than some of the models use, but it's quite useful for one of the ones I'm going to talk about. So imagine that assets comprise of fixed assets. You can think of these as mortgages, corporate loans. The key assumption here is they cannot be used for collateral in repo transactions. Collateral assets, which you can think of as securities, which you can use as collateral to borrow in the interbank market, but only with some sort of haircut. Reverse repo, so your secured interbank lending, which is obviously you're getting collateral for, at a haircut. Unsecured interbank assets, they are endogenously determined by the way the network is drawn. Okay? And then liquid assets, which for the purposes of this, you can think of as a very high quality asset, which don't ever have a haircut, can always be sold as par. If you want to think of it as just simple cash or central bank reserves, you could probably think of it as high quality government bonds, perhaps. Then on the liability side, maybe easy to start. Interbank liabilities, which are these are not necessarily the same, right? They're driven by the network. You have some unsecured interbank liabilities. Repo borrowing, so secured borrowing. Retail deposits, which don't really play any role in the model, that's the D up there. And then capital, which is the excess of passive assets of the liabilities. As Doyle spoke about, a lot of the early models sort of said, well, some banks, take a loss on some assets, and then there was default contagion. So, because some asset class went bad, a bank went bust, its capital was wiped out, and because of that, it defaulted on its liabilities to other banks. That created counterparty losses on the asset side of other banks, and that leads to these sort of domino effects. So that's what quite a lot of the early literature did. However, what you saw in the crisis, some of this went on, but what you saw in the crisis, that changes were often more pronounced in debt than in equity. That's sort of Shin's work on the financial crisis. We know that liquidity hoarding played a key role, fire sales, and so on. So the example, so you could bring in fire sales here, by sort of saying that once you've lost this counterpart, you could have a fire sale loss. But I'm going to focus in the next thing more on the liquidity hoarding dimension. So now suppose instead of the previous shock where there was a loss in assets, suppose the shock is very similar to what we had in 2007. People are worrying about the collateral that's used in repo transactions and other securities, so subprime securities, for example, and haircuts spike. At the same time, banks are required to make liquidity calls. Perhaps they need to fund some special purpose vehicles, some conduits, so they have a liquidity shock. You can represent that as a sort of a loss of repo funding. Now, how can banks meet that sort of outflow? Well, they've got some liquid assets, but suppose those liquid assets are not sufficient. Then one possible response is to withdraw the interbank assets from other banks that they were previously lending to in the interbank market. But then that leads to a counterparty funding shock for other banks. So this is a sort of a liquidity hoarding dynamic that can break out following sort of these haircut shocks, which set the whole thing off. So this is what we try and model in this particular paper. So to explain a bit of the setup so you understand the chart, what we've got here is firstly the network. We've drawn a distribution. It's a fat-tailed network distribution. So you have concentration in the network, which is broadly consistent with what you see. The shock here is there's a single bank that suffers a big repo shock and starts hoarding in the interbank market. And then what I'm looking for is whether there's a systemic liquidity crisis in which almost all of the banks end up hoarding because the shock propagates through the system. So, and what's driving that is the same tipping point contagion dynamic that I had in the epidemiology example. Okay, that's the intuition for what's going on. Now, what I've got here is in the crosses is the frequency of a systemic crisis, and here is condition line breaking out what proportion of the system is affected. So you can see that there is, for quite a wide range of connectivity, you've got a possibility a crisis, and that when it occurs, it's pretty system-wide. That is for a shock targeted at a random bank in the network, okay? But now suppose that instead of targeting just any bank in the network, I target the most connected bank in the network, and recall that this is a fat-tailed distribution. Otherwise, everything is the same. Now we get the right-hand chart. You find that contagion for a large range of connectivity always occurs, and it's pretty catastrophic. So this really highlights the importance of key nodes to the network. You know, and I think it really it highlights that you know, the role that these super spreaders can play in contagion. What about policy responses? Let's go back. Return to this random shock case. So have this chart, left-hand chart, back in mind. And now suppose that I say banks didn't have very much liquidity before the crisis, which is true. Let's suppose that we raise liquid asset requirements. So the left-hand chart takes the same random shock, raises liquidity requirements, and as you might expect, that acts as a dampener on contagion, so you can reduce the frequency of contagion, and it's not so bad some of the time. But now suppose that instead of just saying all banks hold more liquidity, I give exactly the same amount of liquidity to the system, extra liquidity to the system, but I target it at those banks that are most important in the interbank market. So it's distributed according to the most interconnected banks. And that's the right-hand chart. You reduce the frequency, you have even when it occurs, it's nowhere near as bad a lot of the time. And otherwise, it's the same amount of liquidity going to the system, but it's targeted. So again, this is like the targeted vaccination idea. Targeted liquidity dominates. The difference here is that, you know, with vaccination, it doesn't really necessarily change, well, it might change behaviour a bit, but if I put higher liquidity requirements on banks, to the extent that those are costly, they might also have a positive incentive effect and encourage those banks to become less connected and less systemically important. That's all static. And I said one of the motivating stories here is that, you know, haircut shocks are the source of the crisis. But we know that, you know, haircuts tend to fall over the economic cycle. So you could almost think of this axis here, which is the initial aggregate haircut, as time. And what I've plotted here is the frequency of crisis as a function of the initial haircut, so time. And you can see that as haircuts fall, the risk of a crisis increases over time. Now, one response would be, well, maybe just let's ban haircuts below 20 or 15 or whatever number you want to choose. Another sort, which is, you know, one possible thing is there are talks about minimum haircuts. Another possible response is to say, as time progresses, I'm going to ask banks to hold more liquidity to compensate for the increasing risk. That's what these two lines do. They say, as haircuts fall, hold more liquid assets, and I can make the system more resilient, and I can offset this sort of time-varying systemic risk. So what I'm doing here is I'm building resilience to shocks. I may also curb exuberance, and this links to sort of broader time-varying macroprudential policy. And the point I want to draw out here is that macroprudential policy is often talked about, you know, real economy assets. It's equally important when thinking about intra-financial system activity, and this is the sort of example that you might think about. Now, there's some behaviour in the model that I've showed you so far. There's liquidity hoarding. Other models have fire sales. But, you know, hoarding is not just a mechanical response to sort of haircut shocks or counterparty funding shocks. It also has other reasons. And this next example shows some of those other reasons. So first I'll define a few terms. So I'm going to call individual bank health a function of its capital position and its maturity mismatch, where maturity mismatch is, you know, how much short-term liquidity you've got compared to short-term liabilities. So you've got a lot of maturity mismatch or weak capital, your own health falls. I'm going to define system confidence as a product of the amount of interbank activity that's gone. So if people are fleeing from the interbank market, E falls, or if there's a lot of default or lots of losses on assets, then A falls. And then what we do is we say that banks, the lending here has two maturities, long maturity and short maturity, that banks will shorten the maturity at which they're prepared to lend if either their own health is not very good, that's the precautionary hoarding from the previous model, roughly speaking, but also if their counterparty risk is high. So if they're worried about their counterparties, they might hoard, or if confidence in the system has sort of collapsed. So Ricardo talked about some reasons why confidence might suddenly collapse. And that obviously improves their own health with acceptance of the system. And then there's a sort of more severe condition where banks can withdraw their lending altogether. Now this model also integrates fire sales and default contagion and differential bank sizes. On fire sales, it picks up on one of Dane's points. So we have a range of different asset classes. Each asset class is held by some banks, but you know, there are different banks holding different asset classes. The bigger banks are more diversified. Differential bank sizes, so some banks are basically bigger than others, lambda times bigger, there are fewer of them. And the shock here is a failure of a single large bank. And what I've shown you here is the effects of hoarding. So what you've got here is, we're looking at a large bank defaults or fails, what is the amount of contagion at different capital ratios. And what you can see is that when you allow for these liquidity hoarding effects, you need much higher, or contagion is much worse until you get to much higher sort of capital ratios. So it really amplifies some of the effects in the model. I said we have differential bank sizes, so just one sort of another chart from the paper just to illustrate how we can use that. What we show here is sort of failures as a function of small and large bank capital. So suppose I want to increase capital requirements. Again, what this shows is that big bank capital is you know, if it falls, it's really, you get a lot of contagion from if big banks are undercapitalised. You don't get very much contagion when small banks are undercapitalised. So again, you want to target capital of the bigger banks. So the broad lessons of both of these approaches, you want capital and liquidity surcharges potentially for these systemically important institutions. That's very much in line with sort of Basel proposals, with what the ICB has talked about, trying to make nodes more resilient, but potentially also with positive incentive effects. But you also, because of the network, because of interfinancial system activity, you also want time-varying macroprudential policies to mitigate the effects of the procyclicality you see. You know, I've shown you something about time-varying liquidity requirements or haircuts. You could also think about risk weights or increasing the risk weight on intra-financial system exposures as a response. There are some broader policy implications about data and transparency being useful. So, for example, real-time mapping in SARS was potentially helpful in containing the outbreak, and you might want to try and map contagion of the system across the system. Also, better data might help to mitigate some of the uncertainty that leads to contagion. Netting and central clearing and similarly simplifying the structure of the system can help to promote simplicity, modularity in the system. Those are less direct consequences of the model, but they're linked to some of the broader themes. Now that's all quite theoretical. In the last 2 or 3 minutes, I just want to say a couple of words about some empirical or stress testing type applications. I'll only choose one of them. What I want to get across though is that you can think about the stress testing thing where you model things from a bank balance sheet, which is the one I'm going to show you. But you could also try to think about calibrating these network models to the data and actually trying to see if you can get distributions that look like what we see in the data. So this is trying to make some of these things a bit more real, a bit more relevant to risk assessment. So the Ramsey model, this is the bank's stress testing model. In some respects, it's very like other stress testing models. You have a bunch of shocks which are generated by a macro model, or you can run a particular scenario. That leads banks to have credit losses, market, loss of income, and that affects their individual bank P&L. So we have the largest UK bank balance sheets, we model them individually, see how the shocks hit the system. That's all for the first round effects. That's the core of what it currently does. The way in which we're thinking of enriching it, and we have some sort of proof of concept, I would say, type ways of building these things in quantitatively, is to bring in feedback effects into the model. So this picture gives you a sense of how they would come in. So instead of the shock, if the P&L is bad, the bank might get funding problem, might suffer funding problems, it loses liquidity in the market. And then if it fails, well, there's a network which gives counterparty risk, but we're also trying to bring in these sort of effects of liquidity hoarding. So if a bank is constrained, then it might hoard liquidity in the market, it might sell assets in a fire sale. There are also direct confidence channels. So those are the sorts of feedbacks that we try to bring in the model. To see the difference that it makes, this left-hand chart shows you a distribution. This is just a stylized simulation a 3-year projection from, say, I think it was end 2007 forwards. The left-hand chart shows you the projection with and without, so this is without any of those feedbacks. There are actually a few small bank defaults in this table. Now I add the feedbacks on, and I suddenly get a lot more amplification and a lot more perhaps of what you think might happen in a crisis. So again, this is trying to illustrate that you can try to think about building these feedbacks into quantitative models. I'm not going to go through this. This is a calibration. This is a calibration of a similar sort of idea. And then just to wrap up, I hope I've tried to show you that network approaches might have a little bit to offer in terms of thinking about financial systems and contagion. But I wanted to sort of highlight some what I think perhaps key challenges are, areas for future work. There is some behaviour in what I showed you, I hope you're convinced there is some. But I think you might want a stronger role for behaviour. There's nothing about the formation of links, for example, which might be important in that procyclicality. I think you'd want to bring that in. And a stronger role for uncertainty. And with those sorts of features, I think you could get a stronger endogenous procyclicality, endogenous shocks into the model. Bringing these models more closely to the data and to the, and trying to build on these empirical models that I've started to show in the last couple of slides. So these are just, these are in some respects, these are quite micro models, but I think you could integrate them, doesn't really matter what paradigm you have, you could integrate them potentially into DSG models or into agent-based models, and I think in both cases there could be useful insights from bringing them in. And then, Jean-Philippe talks about how, you can think about these techniques more broadly in terms of social contagion. It also relates to Ricardo's talk on how information might spread and disseminate across society. So that's the sort of set of things where I think might be interesting ways forward.
Thank you very much. Neil.
It's quite a challenge to be invited here, knowing I'm not an economist at all. I'll explain a bit of my background. I run a MRC, Medical Research Council, centre at Imperial College, and now head of department of Infectious Disease Epidemiology. My background is a long time ago. I was a theoretical particle physicist who moved into biology. This is a slide, a cartoon. The reception to the last talk and the heat and the temperature rising in the room made me feel that biologists are not the only people who resent physicists coming into their discipline. But a little bit about the analogies which were highlighted in the last talk. And I think it's perhaps important to, well, first of all, recognise ecology and epidemiology are very broad disciplines in their own right and have many different models and approaches to data, but also to highlight that quite often these analogies are more metaphor than precise mathematical analogies. So, of course, we're dealing in each case with complex systems, so we do get critical phenomena, multiple stable points and the like. But maybe in terms of the evolution of the discipline, there are some more parallels, particularly in relation to ecology, and maybe a little less so with epidemiology. Now, again, this is a caricature of really history, because really in saying for what ecology, evolutionary biology was like 40 years ago, I'm really talking about a subset of ecology and evolution, that which was concerned with the dynamics and evolution and stability of ecosystems, of systems of species, rather than maybe just one or two species interacting. As was pointed out in the last session, models like the Lotka-Volterra model, which can easily generate endogenous cycles in the right conditions, which is a model of a relatively limited number of species interacting, those have been known to be, they certainly haven't been considered in an equilibrium context. They generate endogenous dynamics. But scaling up, and all the work on food webs back in the 1960s and 70s, and then more elaborate models, were concerned with how do ecosystems evolve and stabilize themselves, niche adaptation and the like. And historically, broad generalization, ecological or evolutionary fitness was viewed in many of these models as a fairly static and fundamental attribute, which, if it did change gradually over time, there was almost kind of still a renaissance there that, which came all the way back from the 19th century in Darwin's theories, that somehow life was getting better. Evolution was this positive force, making everything more complex, efficient, and stable. And that stability was typically the norm in ecosystems, and it was exogenous, should I say, shocks or cycles. By cycles, I mean things like climate cycles of seasonal forcing on an annual basis, which would generate or move you away from that stability. And partly because we never had the computers or the analytical tools to do it, equilibrium analysis was dominant. Sometimes it went on to more elaborate stability analysis. And there was a fairly optimistic air with the advent of the first affordable, reasonable power computers in the 1970s that you might even, in some sense, solve ecology, build a sufficiently elaborate food web model of interactions and attempt to measure all these quantities and get a simulation which in some sense reproduced what we saw in different ecosystems shown on the right there. I mean, that project failed fairly abysmally, and a lot of the lessons from the analogy to microeconomics, the micro-studies, started coming through to the systems analysis. So one of the important concepts is that fitness, in a Darwinian sense, individual fitness, is what ecologists, geneticists call frequency dependent. By that it means your fitness to reproduce is dependent on the relative how common you are, and your competitors or prey or whatever are in the population. And so it's a context-dependent thing, determined not just by the state variables of the system at the current time, but also by exogenous state variables, which might be climate or environment related. And by definition, I mean, this is very destabilizing because it generates even more very positive and negative feedback loops. It means that fitness is a fairly transient and relative quantity. Fitness was always a relative quantity, of course. That led to concepts that evolution was often punctuated and certainly wasn't globally optimal. This nice Renaissance view that life was getting more perfect is far from the case. Life is very good at adapting to local circumstances, but quite often in an imperfect way, and evolution, classic examples might be tail plumage of pheasants. Evolution is very good at sending species down blind avenues. But complex ecosystems are fragile came out. Classic work by Bob May, Simon Levin and others. And it's important to define what we mean by complexity here. Complexity is not necessarily the diversity of a system. I'll talk a little bit about the conflicting literature on biodiversity in a second. Complexity is the number of interconnections in the network which are critical to the survival of particular species. And the rainforest is an example of that. So, in some sense, what you might say, the bottom ecosystem savanna is less complex. It's not necessarily, well, it is less diverse, but the order of the biodiversity is not as less as you might imagine from rainforests. But the webs, the food webs, and the local adaptation in the rainforest context is much more specialised. There are no real long-term equilibria anymore. And clearly you can define some sort of quasi-equilibria if you look at the right time scale, but in terms of the long term, it's very hard to find equilibrium in the system. And of course these are complex systems, you get emergent dynamics, multiple attractors, and I would hesitate to say chaos. I'm not a great believer in, I think stochasticity dominates more than true chaotic behaviour in certain biological systems, but certainly you get intermittency. Another very important thing which comes out of studying actually both of these systems and epidemiological systems is that spatial locality and mobility of populations are key. We do not interact with all other members of a population, we interact locally. And the network paradigm is one way of representing that. Sometimes it's appropriate, sometimes it's not. But certainly in biological systems, spatial locality is key. And the other thing which has happened is in the last 40 years, more recently that, there's been a real revolution in the availability of data, both from genetic data, sequence data, but also in terms of studying ecosystems, remote sensing data, or automated data collection, and a parallel revolution in how to handle that data. And in particular, I'd highlight things like particle filter, sequential Monte Carlo methods for trying to infer mechanisms of population interactions from time series and spatial data. What about infectious disease epidemiology? Well, first of all, regardless of what Bob may think, it's not actually just a branch of ecology. It actually has multiple origins. Ecology is one of the origins because epidemiology of infectious diseases is a form of population biology, of interacting species. But it also has very strong roots in biometrics and biomathematics as well, and statistics. And because it is a biomedical discipline, it's always had more relevance, or more applied relevance in health than perhaps ecology has in policy. It has to say, from the point of view of modelling, whilst it's got a long history, all the way back to Bernoulli, who first studied the population mortality impact of smallpox, there's been plenty of scepticism, particularly in the practitioner community, about the role of modelling. And that's gradually changing as techniques have got more efficient. But there are some simple basic underlying concepts, like branching process theory, which immediately leads you to concepts like the reproduction number, the quantity mentioned in the last talk, and critical bifurcations between an epidemic unable to spread and an epidemic to spread. But we've moved, as in ecology, a long way from the historical emphasis on equilibrium analysis, again, to looking at non-equilibrium stochastic models with rigorous inference. And a lot of the trends, cut off at the bottom, mirror those seen in ecology, emphasis on spatial locality, evolution, and also increasingly on control policies which are rather than blanket control policies targeted at nodes of greatest effect. A quick example of this work I've been doing, which is a very large scale, in some sense very simple Asian-based model of 800 million people in Africa. This models the dynamics of malaria transmission in Africa. An interesting system because it's both endogenously and exogenously forced. There's endogenous dynamics in terms of the transmission dynamics, but layered on top of that a lot of climate variables coming in. And this is fairly rigorously parameterized with remote sensing data, a huge amount of disease surveillance data to go into it. Why are we doing this sort of thing? Well, we're doing this work for the Gates Foundation to ask how would different control strategies optimally eliminate or potentially eliminate malaria or control malaria transmission. In terms of analogies with contagion and distress, I would again highlight that I think there are more analogies. Maybe if you simplify the model enough, you can get to direct comparability. But the questions I have coming out, and they've been mentioned multiple times before, so I'll go quickly given I'm running out of time here, then clearly there's some clear lessons. Homogeneity in epidemic systems gives larger epidemics. If you have more heterogeneity, they tend to be smaller. My real question coming out of the last talk, and it was interesting, two different models were presented, is the extent to which the interbank lending network is the thing really driving failure in this system, or is it more the rumour or the loss of confidence, which is a more global collective phenomenon rather than mediated through pairwise links. Hierarchical cascades have been mentioned. Also, I had some slight concerns about, this is what I would call a final size distribution in an epidemic model. It says, if you introduce an infection in one place, either in a small index bank or big index bank, what's the size of outbreak you get measured in bank failure? The fact is, this is what you would expect to see in an epidemic model. Small, some probability of a small outbreak, and then some probability of a very large outbreak. But in this case, you're getting all of the banks failing. And that worries me slightly in terms of, is that an entirely realistic assumption? Is it indicative of maybe unrealistic symmetry or degeneracy? You'd expect a broader continuum of outcomes. But perhaps the key point I want to get across here is, I think this is fascinating from the kind of regulatory perspective of how do we make bank failures less bad next time, but it doesn't necessarily explain the causes of failure or necessarily the vulnerability of banks. I mean, what are large banks, in terms of looking at network structure, bank size distribution, are banks which are large less or more likely to be the ones which trigger that failure? What's the relative chance of this happening versus this happening? Just my final slide, and an outsider's view, and I don't want to be too controversial out on the last, my last slide, and given the reception of in the last session of absolute criticism, and I'm another physicist coming in. I was surprised, but pleasantly surprised this morning, but I was rather surprised yesterday on how little focus on data there was in all the discussions. And apparent lack of use, at least, I wouldn't like to say knowledge, but use of modern statistical methods, which have moved on dramatically in the biological and physical sciences. A slightly surprising emphasis on analytical tractability, even if the cost is having to make very sweeping assumptions. Relatively little focus on dynamics, still, more focus than perhaps I expected, but almost none on really a rigorous treatment of stochasticity in these systems, of the locality of interactions. Experiments. I know in developmental economics and health economics, experiments are popular. What about in macroeconomics? And I'll leave my...
We're doing them all the time.
Yes, that's not a randomised controlled trial. And my final point, I mean, I think Asian-based models or individual-based models have a lot of potential, but they're still lessons from other disciplines, and I'll finish here. They're not a panacea. They give huge model choice problems and model parameterization and validation problems. Thanks.
Thank you very much. I'm not sure we should be talking about experiments with Bank of England people here. I think maybe quick response.
Just very quick. So maybe just 3 quick points. I guess I'll focus more on the sort of specific discussion towards the end. On whether it's confidence or the network, I mean, I think that's part of the reason we put both in the second model. I think there was probably both going on. We have, some market intelligence information about how banks were losing funding, and that was, people were sort of pausing for precautionary reasons. Clearly, confidence mattered. I think what was clear in terms of the evidence was that, repo markets and unsecured markets both collapsed, so the network did collapse. Symmetry, I completely take the point, that's obviously a consequence of the really stylized model that you get the binary outcomes. I would say something like the Ramsey distribution that I showed is, that's a more plausible sort of distribution. When you have a fat tail and there's a distribution rather than just this very binary outcome. That's obviously a consequence of the theoretical model. And yeah, you're right, I agree. One of the peak areas for work is think more about, this is very much the implications of shocks, largely. I think the procyclicality elements trying to get a little bit of the causes of shocks, but I think trying to understand what drives shocks and when the system is vulnerable is a really important area. So this is the procyclicality.
Thanks. David Henry was first.
Yeah, I think the bank should do experiments. I think they should do simple experiments like randomly perturbing a bill issue, for example, treasury bill issue, a given frequency and a given magnitude, to see the perturb. We could then trace it statistically through the system. I've tried for years to get them to do it. There are other areas in which the treasury could do experiments, and they'd be tiny but very important information for time-saving people.
Mark.
First, great presentation. I found it really illuminating. Second, a suggestion on how to really pin down what it is that the network is doing. And it might be interesting to think about whether there does or does not exist an observational equivalence between the network and a representative bank. Let me give you an example. Suppose there's a representative bank holding mortgage-backed securities, funding these with short-term debt and little capital. And that's a banking system that's I would consider highly vulnerable. Now consider a system with 2 banks. That is, one holds all the mortgage-backed securities, and it funds this from borrowing from another bank and by issuing short-term debt. And the bank that made the loans to the bank holding the mortgages also issued short-term debt. In the aggregate positions, the net positions of the network will just look like the net positions of the representative bank. Then the question is, do you have an observational equivalence? That would mean that it's the net position that matters to the regulator, not the network. Or are there reasons in the model where the gross positions are going to matter independently of net positions? And so I could believe you could probably find both, but by thinking of it in those terms, you can really sharpen what the network's doing.
Let me respond to that quickly.
Yeah, so on David's point, I'll take it back. I do think macro is probably a difficult area, but I do think the work in development economics on randomised trials is very useful. Thinking about experiments in terms of what interventions work is a very useful way forward for the progression. So on this point, I think there are two things. So I didn't want to go into the detail. Why the gross position is mattering here to a certain degree. There are two reasons. One, the most obvious is the position in the network matters. So the distribution of links is not homogeneous. So there are some banks that are very, very highly connected to. They're going to have that's what. So even if they have the same sort of look probably the same, if they're very central to the network, they're going to have more of an impact on the network rather than a representative bank on the outside. In terms of the very specific thing about what's the amplifier, could I just net it all out? There's one thing that's going on in these models is that when I'm forwarding liquidity, there's an assumption here that I'm worried about future liquidity shocks as well. So that is built into the model. So when I'm forwarding, between some parameters between 0 and 1, I'm hoarding more than I've lost because I'm worried about future outflows. That's in that direction. On the default contagion, there are some bankruptcy costs, which is going to amplify as institutions fail. There might be some outside dead weight
Certainly
outside.
a bankruptcy cost with the gross positions would do it.
Yeah.
We've got several people in the queue. David Miles was next.
This is a question about policy, really. I think you suggested a sensible policy response to these kind of network problems and contagion liquidity might be to have time-varying liquidity requirements on banks. But I think you showed us a very telling picture, which actually seemed to me to show that just having higher capital requirements just gets rid of the problem. Now, that wouldn't be a very good answer if having banks hold on average much more capital, i.e. much more equity funding, was dramatically costly. But it seems to me that most of the arguments, and you hear them a lot from bankers about why holding equity capital is terribly costly, are largely complete nonsense. My favourite one being bankers who say, oh, if we hold more capital, that's just money that's tied up doing nothing in a vault. They haven't realised that apparently that equity funding is a source of funding for lending. I'd be interested in your response to that.
You would say that, wouldn't you? Charles?
You wouldn't get very far studying the ecosystem of foxes and pheasants in this country if you didn't take into account the actions of gamekeepers. Now, in exactly the same way, the amount of liquidity that any bank needs depends on the rules of the game that the central bank operates. And the central bank is conspicuously absent from your particular model. My erstwhile colleague, Willem Boyter, has always taken the line that central banks can create liquidity against anything at any time, and therefore there's no need for any bank ever to hold any liquidity. I don't take as extreme a view, but I think that the liquidity coverage ratio should much better be entitled the be kind to central bank ratio, because what it actually does is it gives the central bank time to actually get into the system and see what ought to be done. But isn't your model about you ought to have liquidity there and liquidity there and more liquidity for this and more liquidity for that? It makes no sense at all unless you actually specify the rules of the game that the central bank is operating.
One more, and then another response. Ricardo was next.
Following that, I didn't quite understand what was the cost of regulation in your model. I mean, so when you put these capital requirements, what's the cost that prevents you from just regulating everything? And especially, how does that affect the strength of the network?
Okay, so I'll take the last first because it relates to Dave's question too. But, I mean, so essentially this is just looking at systemic cascades, and it's assuming that essentially there's no cost to banks of putting these requirements on. So you really want to do a proper cost-benefit analysis of the type that Dave has done on the capital side. Now, I mean, one experiment where the reason I showed the targeting liquidity experiment is because that's got the same amount of extra liquidity going into the system, liquid asset requirements, but it's targeted at particular institutions. And so in a sense you should think that the cost is pretty similar across those cases.
No, when you target it, you're going to change the incentives for the banks to connect with each
Yeah,
other.
you're right, but I guess we're arguing that that's probably going to likely to. I agree it's not a model, but it's likely to have a beneficial effect. But to do this properly in terms of how you set regulation, we want to do a cost-benefit analysis, which relates to sort of David's question. So I, as you know, completely agree that higher capital requirements would be very helpful. I suppose the 2 points I would make is to the extent that it might be either there are some costs or that it's difficult to achieve them for whatever practical reasons. You might say that the lessons of this model is that, well, at least get high capital requirements in the big systemically important institutions. They're the really key ones that where you need the extra capital. So you can't get it, it's hard to achieve on everyone, or there are some costs. That's the way of targeting it. I guess it's an open question, and it relates to Charles's question, on whether having adequate capitalisation can eliminate, or if you have basically zero liquid assets, whether that can eliminate all liquidity risks. So I guess there's still a question about whether there's still liquidity risk in the system. I think at very low levels of liquidity, I think there can still be a risk of sort of these sort of runs on repos. On Charles's question, so in terms of just to be clear on what the assumption is in the model, it's that the central, or both models, is the central bank is not giving more generous, it's not offering funding at more generous haircuts than the market is prepared to offer. That's what's going on, which basically means it has no role, as you say. What I would say, the reason, now clearly that liquidity provision matters. The reason for sort of abstracting from this is that we think, there are two reasons. One is that we think there's a sort of, we want to articulate a network of externalities, the externalities that are going on, which banks are not internalising. And so there might be, you might want some central bank liquidity backstop, but if you buy the argument that there are externalities, you're basically saying the banks themselves are under-insuring, and therefore, because they're not internalising the externality, and if you just put the insurance on, you might create more moral hazard than might be desirable. The second thing, I guess, would be a stigma thing, so even if the central bank does provide liquidity, what we saw in the crisis is that banks were very, very reluctant to be seen to be going to get liquidity. So they might still hoard liquidity according to these dynamics, even if there is a central bank option.
Dwayne. Yeah.
So in your talk, you mentioned dynamic liquidity requirements, and I think it's a case where agent-based modeling can play a role. We have an agent-based model where we have a much less rich network structure, but a richer dynamical structure. And what we see is that when we put in dynamic liquidity requirements, it can be beneficial if everybody's leverage is low enough, but when the average leverage gets higher, you actually have a counterproductive effect because you get a big systemic effect, and it's not surprising because if banks are highly leveraged and then you say, okay, now you have to have less leverage, then you have waves of selling which depresses prices, which causes more selling, and you can actually generate crashes that way. And so I think you just have to be careful in proposing that until you really understood the dynamics. The systematic effects of the dynamic liquidity requirement.
Yeah.
And I think it's actually a good case where these kind of models can work together.
No, I agree. So the question that Paul asked last night, that was in capital space, but that was the basic, it's the spirit of the question, is if you raise capital requirements, we know that it builds resilience into the system, but it might have all sorts of different dynamic effects, and it's really important to try to understand that. I would say in liquidity space, it's exactly the same.
Bridget.
It seems to me that we're missing something out of in this discussion of what's coming out of your models, which is that there is probabilistic behaviour built into them. So that every time you run the model, you get a different answer. So what we've got here is something which is trying to tell us about some of the distribution of potential outcomes, not just pull this, get that.
Yeah.
And so maybe one of the things that we really need to understand for policy purposes is what is the likelihood that we'll get what we want from our intervention, and what's the likelihood that you're somewhere in the tail of those distributions. And I would like to see us thinking about that a lot more, because after all, we know you do a policy intervention and you get unintended consequences. We need to understand the range of unintended consequences. What's the box that we're operating in? And these kind of models do some of that, but we need to make more of it.
Neil.
My question is actually for both Neil and Sujit, and it is really concerning you expanding a little on the implications for policy appropriateness depending upon the state. So for instance, increasing capital requirements could have very different implications pre-crisis, during crisis, or after crisis. Vaccines and quarantine could have very different implications pre-epidemic, during the epidemic, or after. And what can we say about different policies at different timings, and also whether, you know, what goes on in epidemiology and ecology can help us think more about what goes on in economics and perhaps vice versa.
So on the first point, I basically just agree. I think that's, you know, these are pretty toy models, and I think we do need, you know, it's illustrative of an approach, and I think it's really important to try to build in more of those, think about where in the distribution you are. So the stress testing model is trying to take a set of UK banks and try to think about where the risks are on that snapshot of the network and snapshot of balance sheets, and thinking more about the unintended consequences of responses. So I think that's certainly the direction that's really important. On the policy, I mean, I guess I'd set all this up, I was really thinking about ex-ante policy. In a crisis, I mean, you know, again, it relates to the liquidity provision question. So if you wanted to think about crisis, I think you would really want to think about how liquidity is provided and so on. So I guess it's more in the spirit of some of David's work and thinking about, you know, there might clearly, if you were, so David said, well, cost of raising capital is not that high. You know, if you're going to do it, it's probably higher now than it would have been in 2005, arguably. So this is really thinking about ex ante, trying to think about how you make the system more resilient, so that you try to, so when the shocks do come along, it's got better capital and liquidity resilience.
Very brief question, Marcus?
Yes, JP earlier on said it would take 10 years to think about policy responses. We've actually looked at some policies. What about the reaction of the market to try to beat whatever policies you come up with? Don't we have to go even further?
I actually think, so I'm probably biased, but I think, I don't know how many of you have seen Andy Haldane's Jackson Hole speech. I think the lessons from that are quite powerful, but actually what you want is a simple set of rules where that, for me, this is where the disclaimer really comes in, but I would have, go with David and have some you know, higher capital requirements, coupled with a leverage ratio, because the risk weighting, we don't necessarily trust the risk weighting that way, but you need something that's risk weighted and something that's not, and probably some sort of key liquidity standards which might relate to sort of, say, core funding ratios, or so you just have a set of simple metrics, and then, you know, if you get the big picture things right, you know, I mean, David said, well, just need more capital. I'm saying you need 2 or 3 things, but if you get those big picture things right, then I think you can get a long way, and then you don't need to worry too much about all. I mean, you still need to think about the complexities in the game that might go on, but I think simplicity can be quite powerful.
Why not limit the exposure of any given bank to any other given bank?
Yeah.
Which would, by the way, force banks to downsize.
So we have large. I mean, there are large exposure limits. I mean, you could make them more. That would be another simple thing to make things to try to make things simpler and more restrictive. Yes.
Okay, we'll finish there. Thank you very much.